And guess what time it is?
Oh, I know what time it is.
It's time for the Not Your Average Investor Show. We are live on Facebook, Tuesday edition. I'm going to continue to exaggerate the pre-announcement thing as anybody that was here last week, we let you in on that inside joke. Today, we are talking about why it pays to buy rental properties by the end of the year with me, your co-host, Pablo Gonzalez, and my co-host, the guy that they call GC because he clearly is a gravitational force of capital and because his name is Gregg Cohen. Say hello, Greg.
Getting better and better every week, buddy. I'm wondering how many more GCs you can pull out of there, but I like it. Gravitational force of capital. I'll take that one.
I got my little list of like brainstorm GCs that I work on. And when you started talking about fundraising, I was like, oh, I know which one I'm going to. No big deal.
Well played, brother. That's preparation and execution.
You know, man, that person on the top of the mountain did not just land there. You know, you got to climb that mountain. You got to be prepared every day. Anyways, welcome to our guests. Happy to have our usual group of people that join us on a Tuesday and on a Thursday, and it keeps on growing, and it's wonderful. We love it. Welcome, Lee. Welcome, Marilyn. Welcome back, Sean. He's kind of a new addition here that we play spike ball with also on the weekends, Team Cobra. Welcome, Martha. Welcome, Jake. Welcome. I think I already said John Henning. All of you that come here on a regular basis, you know the trick. This is an interactive show. We want to answer your questions. Hello, Leo. Good to see you back as well. We want to give you as much value as possible. And the two ways to interact with us and with each other is number one, the chat box where you're seeing people start to populate. And there's a little trick in the chat box. When you first open it up, you got to hit that blue box that says panelists, drop it down and have it say panelists and attendees, so that everybody else can see your comments and you can interact. And there's some really great knowledge of the crowd that happens during our call. So I really encourage everybody to help us out. Welcome, Miguel Angel from Spain. Welcome. Good to have you back. And then the other thing is, if you want me to ask the gravitational force of capital, Gregg Cohen, a question, you want to pop open that Q&A box and put the question inside the Q&A box, because what you'll notice is that the chat box moves really fast and I'm just not talented enough to keep track of everything, but I do my best, right? So if you want to help me help you, go to the Q&A box. Last but not least, this is your first time. If you want to get a breakdown of what rental property investing is all about, all the lessons learned of the last 15 years of Greg and his team doing it, go to jwbwebclass.com where you'll spend a quality 40, actually it's about to be 20 minutes. We've condensed it to 20 minutes in the interest of time. You'll spend a quality 20 to 45 minutes, depending on what webinar you get, full of good nuggets of the stuff that you need to see. And you'll get to download the free investor toolkit, which we're going to mess around with a little bit today. And we mess around with a lot on Thursdays when we do our property of the week. And if you like what you're hearing, you want to get in and invest before the end of the year and get those benefits going, go to chatwithjwb.com. Pick out a time to talk with our team. It is another valuable use of our time. It is getting to know what your specific situation is, how we can connect the dots for you, and designing something that works for you. But without further ado, Greg, you ready to get on with the show? Listen, I know that I missed running with you this morning, and I'm really beating myself up because when you are talking taxes, you are at an all-time high of happiness. And I imagine that today's run would have been like a blistering 4-minute mile, but we get to do it on the show today, right? We're going to talk about saving taxes and why your financial advisor tells you to invest in rental income properties before the end of the year. You ready for a GC?
Let's go, brother. I love talking taxes. Let's do it.
He's a tax talking. I wish I could build that into the GC thing, but we'll figure that out. All right, Greg.
Silent G.
The G is silent. Greg, you hear it all the time, right? Like I have my financial investor, my financial advisor that's like, hey, before the end of the year, look into this, look into that, right? On this call, we're going to talk specifically what the advantage of getting it in on January 31st versus December 31st versus January 1st.
There we go.
Right. And then we're going to talk about overall tax saving strategies and why rental property investing is so good. But let's start with the immediate benefit. Let's give it away right now for anybody that just came for that.
Mhm.
What's the difference between buying a rental income property on December 31st, 2020 versus January 1st, 2021?
For most investors, to just be very direct, for most investors who invest in a market like Jacksonville, it's going to be a tax savings of somewhere between maybe $1,000 to maybe $1,500 in your pocket, to where you don't have to pay those taxes in the year 2020, or for the tax year 2020. You keep those dollars in your pocket for 2021. So if you're looking for a way, a tax advantageous way to actually keep, call it $1,000 to $1,500 in your pocket, maybe take a nice trip, maybe do something nice for yourself or for your spouse or for your kids, there is a real reason to do that and to buy a property before the end of the year. Do it December 31st versus January 1st. It's a difference of about $1,000 to $1,500 in your pocket.
So it's $1,000 to $1,500 in your pocket. Can you kind of walk me through why that happens, how it happens? Like, why is that?
Yeah, absolutely. So we're going to go through all of the tax savings opportunities with rental properties, which is one of the reasons that I love rental property investing. It's one of the reasons that I'm not alone. Many of you who are watching love tax savings strategies through rental property investings. And it's also the reason that you hear professionals out there say, you got to buy rental properties. You got to buy hard assets. You got to get the tax savings opportunities there. So specifically what we're talking about here, though, we want to answer that question that I know is on a lot of minds of those individuals. When you invest in rental properties, you're going to get the opportunity to get those incredible tax savings whenever you buy those rental properties throughout the year. And if you buy it early on in the year versus the end of the year, most of those tax saving strategies are going to be enjoyed by you on a prorated basis for that year, depending on when you actually close on the property. What I'm speaking about here, and the real reason to buy before the end of the year, is there's one write-off that you can take that happens in the year that you purchase it, that you'll have to wait an entire year next year to take that write-off. And specifically what I'm talking about are the closing costs on the purchase of your rental property. So if we're kind of running the numbers here, and we're saying that typically your purchase price for a property in Jacksonville is about $180,000, and we're saying that typically closing costs for that property is going to be somewhere around 2.5% of that, which gets you to about $4,500 in closing costs. And then you assume that you're in a 30% tax bracket. Well, that's how I'm getting roughly to between $1,000 and $1,500. What happens when you close by December 31st of 2020, you can write off that $4,500. And if you're in the 30% tax bracket, that's going to save you about $1,350 if we're using these numbers. So what that's saying is you close in December of 2020. When it comes time to pay your taxes in 2021, you now have a write-off of $4,500. That's going to save you about $1,350 that you don't have to pay come April of 2021.
Got it. So dollars and cents, we're talking about familiar territory here. We're talking about tax write-ups, all the benefits that come with rental property investing. As far as direct benefit of why financial advisors tell you to do it by the end of the year, it's just time value of money, right? Like you're gonna get this write-off of, I guess, of $4,500. It manifests itself as a positive, I don't know if you call it positive income, right? But like positive cash flow on your tax ledger of around $1,300 to $1,500, something like that. And it's whether or not you're going to get it in April or you're going to get it next April. So it's just money in your pocket now that you're going to get anyways. If you spend a little bit of extra effort to act before the end of the year, you get it in time for, whatever's going on in April.
Yeah, I mean, everything that comes along with a tax saving strategy is paying less in taxes today, because there's value in paying less in taxes today versus paying that same amount in taxes next year. Or if we'll talk about some other strategies today where you don't have to pay for a number of years, right? At the core of it, as you know, much of our country loves 401ks and IRAs, right? And the reason that we love those things is not because we're avoiding paying taxes. It's because we recognize that there's inherent value in keeping that money in our pocket today rather than paying that tax today, right? There's value for having money in your pocket. With that money, you could invest that money and maybe make a nice sensible return on that money, which is then real money that you earned. Or you could go and spend it otherwise, that, you know, for whatever reason you would want to, but, you know, maybe that would take the place of money that you didn't have to borrow, right? But either way you're looking at it, there's inherent value. The whole tax game really is, how can I legally pay less in taxes today and defer those to next year? And if we're just talking about specifically why it would be in your best interest to close December 31st versus January 1st of this year, it's because those closing costs are the only thing that you get to write off today that's not like prorated, right? You get the full write-off in the tax year, whereas all of these other incredible benefits that I'm going to talk about, they're there for you no matter when you close. That's the only difference.
Cool. So there's going to be an ongoing theme of this like time value of money kind of thing going on here. And to break it down in non-tax terms, right? Like as a business owner, right? Like we're always incentivized to send out the invoice and get it in quickly, right? Like the more money you have in your accounts receivables, the less you have in your bank account, the less you're able to use that money to make more money, right? So as a real estate investor, and I get the sense that most of our audience that is investing with you runs this thing kind of like their own kind of side business that you manage for them, or they kind of like Joe Dela Cruz, right, has a legit real estate investing business and is thinking about it, right? So if you don't think about it tax wise, think about it just cash flow wise. It's always better to have the cash under your control, have it in. That being said, if somebody's pushing you too hard to do something by the end of the year, just understand that it is this $1,300, $1,500
Yeah.
benefit.
Wasn't it fun when you and I were talking about the setup for the show? And I'm like, you know what? I'm going to share that it's about $1,000 to maybe $1,500 tax savings. And it's probably going to surprise some people because the amount of push out there to get people to buy properties by the end of the year, you would think it's going to save like tens of thousands of dollars for the average investor. And I just wanted to share that with you guys. When I was investing and starting early on, I would always hear like, wow, you know, everybody is saying I got to close on these properties by the end of the year, by the end of the year, by the end of the year, right? $1,000 to $1,500 is amazing to keep in your pocket. And that's something that you don't get for most other asset classes. But at the same time, the bigger win is all of the other tax advantages that you get no matter when you close. Like that's the bigger deal here, right? This extra $1,000 or $1,500 you get to keep in your pocket, it's just icing on the cake. The real thing that people need to understand, which they don't understand enough of, is what are all of those tax savings? What are all of those write-offs that I get no matter when I close? And then how can that help me defer taxes?
Awesome. Refreshing take, right? Like I remember having that conversation and being like, do we even want to, yeah, you know what? Let's just tell people that it's, you know, it's something, it's not the end of the world. Let's talk about the overall tax benefits. And funny you bring that up because I've got a friend who doesn't understand all the tax write-offs. And he knew that I was going to ask you today. So I was hoping that maybe for my friend, you could tell me what all the tax write-offs are that we're dealing
Friend
with.
of yours is so insightful and just has such good segues in this show. It's amazing. It's uncanny, really. Let's go through this. You know, the tax savings that you get with rental properties, most would agree, are about the best that you can find for most asset classes out there, right? Then it's not even debatable, right? When you compare the tax savings that you get just by standard write-offs with rental properties, it blows stocks and bonds out of the water, it blows most other asset classes out of the water. The reality is that with the rental income that you earn on rental properties, you get to write off almost all of that as far as standard depreciation, as far as standard write-offs, man, I'm excited about depreciation. And then when you throw the write-off of depreciation in there, which is also a standard write-off, it's a huge write-off, which many times allows you to defer paying taxes on the rental income that you earn for many, many years when it comes to rental properties. And let's just take a moment to understand the difference between that and other investments, right? In rental properties, what we're going to dissect here, and I'll break down how you get there, but let's just start like high level here. In rental properties, you earn positive cash flow in your bank account. Let's say that it is $250 a month, which is $3,000 for the year. Let's just say that that's what you earn. It's pretty typical for a Jacksonville property. So Pablo, you're actually earning $3,000 in your bank account, right? If we compare that to stocks, most stocks don't pay dividend. Let's not get specific about this, right? There are some stocks that pay dividends, but they're not very much, right? So in the stock market, you're typically not getting a dividend. You're not getting $3,000 in your bank account that the asset is paying you, right? But the kicker here for rental properties is you earn this $3,000. It's real cash flow that gets into your bank account, but you don't have to pay the taxes on it that day because of these amazing write-offs that you get. Now, listen, I'm not an accountant, right? I'm a real estate investor who's been investing for 15 years. So take this as a real estate investor who's just lived it. And if you want to talk about the specifics on the accounting and all that good stuff, I would encourage you to talk to a CPA. But at the end of the day, what we're talking about here is taking this pile of money that you earn as net rental income. And because of all these write-offs, many times you don't have to pay taxes on the rental income that year. It's deferred for many years down the road, which is a huge concept, right? The ability to earn cash and to not have to pay taxes on it today is what most investors are looking for. That's what attracts people to IRAs and 401ks. So a rental property has similar features, properties. It has similar features to that of a 401k, of an IRA, which you're earning income, right? But you're not having to pay taxes on it today. It's deferred down the road.
Excellent. Okay. So then that makes a lot of sense. Again, we're talking time value of money still, right? Because it is, you're deferring these taxes that you pay down the road. And at the end of the day, that is the wealth creation vehicle that makes it attractive to save for retirement, in an IRA, in a 401k, all these different advantages and levers that we're pulling. So now we have this kind of equal footing between a rental property and what is a IRA, 401k, except for the fact that that cash flow that you're getting right now is real, right?
It's in your personal bank account.
It's in your personal bank account, right? Okay, so that's interesting. So then you mentioned something before. You made a differentiation between standard write-offs and depreciation. Can you tell my friend?
I shouldn't have done that. That was just me saying
Okay.
something that's not real, right? There's no difference between a standard write-off and depreciation. Depreciation is a standard write-off as well. Why don't I go through what you can write off?
Okay,
Many
let's do that.
may not be aware of it. So, and I made sure I got a full list here. So there's a number of them here, right? And feel free to chime in if I forget any of these, because there's a ton of write-offs when it comes to rental property investing. See, you've got your rental income that comes in every single month, but you're not taxed on the full amount of rental income that comes in because you're able to write off your loan interest, right? The interest that you pay on your loan. You're able to write off your property taxes. You're able to write off your insurance costs. You're able to write off your maintenance cost and your repairs if you have to put those in on that year. You're able to write off your property management fees. What else? You're able, if you have utility payments, which as rental property investors, the residents pay utilities, except when the house isn't occupied, you still have utility costs. You get to write off your utility costs. You get to write off your legal and your professional fees. You even get to write off travel expenses. Now there's a caveat here. You want to do this the right way, right? Some people take advantage of this and you shouldn't take advantage of it, but anything that is deemed reasonable and something that a trip that you make often is not something that you can write off. But if you're traveling from, let's say, California to come and meet your property manager in Jacksonville, Florida, you can write off the travel for that. So these are what I think most people kind of have heard before as the write-offs. And when you take the full rental income that comes in and you subtract all of these write-offs, you're left with just a fraction of the income as being not written off, right? So it's not the full $1,200 that you're taxed on. Now we're coming down to, let's say, $300 out of that or $400 out of that. Because you're able to write off really all of your expenses except for principal. You can't write off the principal that you are paying down or that your resident is paying down for you. So just those deductions right there knocks down your taxable income substantially. And then the next thing that we're going to talk about is depreciation. And depreciation takes care of the rest.
Okay.
Most of the time.
So that's a big old list, right? It sounds like if somebody is investing, let's say you live in the Northeast and you invest with JWB and you want to take a trip down to Florida, as long as you are kind of like swinging by Jacksonville and taking a look at your house, that trip is now a write-off, essentially?
Yeah, I would encourage you to reach out to your CPA to find out exactly how to do this the right way and don't take advantage of it. But yes, there are many clients that are able to come from California or the Northeast, schedule a trip to come down, meet with JWB, take a tour of their properties, in essence, manage their rental portfolio, and they're able to write that off.
Okay, that's wonderful. So that sounds like a nice move for anybody in the Northeast who wants to check in on their rental property in the winter. It's pretty nice down here.
There you go.
Okay, great. So I've got a comment here from Zach Correa, and Margaret added to it here in the chat, which I think is interesting. And maybe we can talk about this in the frame of you're about to talk about depreciation, right? But Zach writes, aloha, Zach, by the way. After all of the write-offs you get on your rental properties, your rental property income essentially becomes tax-free. And then Margaret Smith said, until you sell it, Zach, then you have to pay back all the depreciation you took. Can you explain that to me?
Yes, absolutely. So, well, why don't we go through depreciation first, and then we'll end the depreciation conversation talking about the answer to that question, if that's okay, Zach and Margaret. I appreciate that question. But let's talk about how amazing depreciation is here. All right. So what we had just talked about was you got rental income coming in. Let's say it's $1,200 a month. You're not fully taxed on $1,200 a month as far as what you have to pay taxes on. You just had all those write-offs that I was just talking about, and it probably chunked it down to maybe, let's say, $300 a month. Maybe that's $3,500 to $4,000 total for the year that would otherwise be taxable, right? And rental income would be taxed at your federal income tax bracket. Well, we haven't talked about depreciation yet, all right? And when I'm talking about depreciation, I'm only talking about it from a tax savings perspective. This is not value depreciation or appreciation. It's not talking about that type of depreciation at all. What we're talking about is the fact that the IRS gives you credit for the things that break down over time in your rental property. All right, that's what depreciation from a tax perspective is. The IRS has established that over 27 and a half years, they allow you to fully depreciate your building. And the key here is that this depreciation is something you can take even if you don't have any maintenance costs, even if you don't have any repair cost, even if you don't have any capital expenditures, you're still able to take this write-off. It's a non-cash event, right? This write-off happens even if you didn't put any money out there. And so it's really critical. This is, why most people love rental property investing from a tax perspective more than anything else is this depreciation write-off. So tying it back to maybe that $3,500 or $4,000 of kind of, let's say, taxable income that you would still have. Well, let's break down how much this write-off would be from depreciation. All right. What you're allowed to do is to depreciate the value of your building. You find out what the value of the building is, and then you divide that by 27 and a half years. And for most rental properties in Jacksonville, that's going to be a write-off of maybe $5,000, maybe $6,000 for the year. So when I was explaining, hey, listen, you've got maybe $3,500 or $4,000 of taxable income after those first round of write-offs happen, now you've got this additional write-off from depreciation that you may not have even spent money on, right? Those other ones you actually had to pay, but depreciation, may not have even had to spend money on that. And chances are you didn't spend $5,000 or $6,000, right? But you're able to take that $5,000 or $6,000 and it offsets that $3,500 to $4,000. And that's why this is a tax deferment strategy. You're able to put $3,000 or so, $3,500 of real cash in your bank account, and you paid zero on the taxes in that year because of the depreciation write-off. And that's really the secret sauce behind how rental property investing allows you to defer taxes every year.
Okay, so let me break that down in a way that I can try to reframe it to see if I understood it. So there are costs that you're actually paying for. The things that you said before: insurance,
Property
maintenance,
management fees, taxes.
yeah, property management. That actually comes out of your pocket, right? Like that is actually money that comes out of the rent that they're paying, and it goes to somebody. That doesn't go straight into your pocket. Then there is a profit on that, on a gross, gross or net profit scale. But then on top of that, there's this idea that if you subtract the land value and you take the value of the home and the building that's in it, you can divide that by 12, and you can then count on those, on that X over 12 as also a yearly subtraction that goes, it counts the same as a legal fee that you paid out of your pocket. It counts the same as an insurance premium, but it never came out of your pocket. It just subtracts from the denominator of what you are dividing into. And that gives you by itself a saving on tax that is a net cash flow into your pocket.
Yes, absolutely. The key here is that there's a difference between a cash event write-off, which is your property taxes, your insurance costs, some of those things that we just mentioned. You actually had to spend money on it, and then you get to write it off. Well, and that's great, right? You don't get those in other asset classes. But in real estate and rental property investing, you get something called a non-cash event write-off, which is depreciation. Those are incredible because those non-cash event write-offs are substantial and they offset any gains that you made in your net rental income, which will leave you with $0 to pay in taxes on that rental income for that year. And now I think we can sort of get into to Zach's question. And I know Mike Foster chimed in here talking about depreciation recapture. So, this does not mean that you avoid taxes forever, right? This is great that we're able to defer them using this strategy, but you eventually do have to pay taxes on the sale, right? And so what happens is the depreciation that you've taken, let's say for the next 27 and a half years, right? You've fully depreciated your asset. Well, when it comes time to sell the property, your basis on that property is now zero. And so the full amount that you sell the property for will be taxable, which means that you will pay taxes on this, including what you depreciated. You will pay those taxes upon sale. But there is huge value in waiting until the sale happens, because for some investors, sale may not happen, right? And for those who hold and buy and hold like I do, it's going to happen many, many years down the road. And so the brunt of your taxes get paid at the end. That's when I like to pay taxes. I don't like to pay them up front.
Makes a lot of sense. So you are, yeah, it's deferment, right? It is turning the tables of cash flow in your favor, the same way that favorable terms on a business or favorable terms on any kind of transaction, right? It's the reason we have credit cards. Is the reason for anything. It's because it is more valuable for us to have the cash in hand with the asset and then get penalized later because of what you can do with that cash in the meantime until it all happens.
Yeah, exactly. Do you think that you could do something worthwhile with, let's say that you earned, let's say that there's a couple $1,000 real tax savings over the next 27 and a half years. If somebody gave you $2,000 every year that you didn't have to pay in taxes, over the next 27 and a half years, do you think you'd be able to do something worthwhile with that money? Absolutely. It'd be well over $55,000 that you have in your bank account, right? That's the value here. That's what this asset is allowing you to create. It's keeping those tax savings in your pocket, not having to spend the money on the taxes for the rental income that you earned. And then the cumulative effects of not being held back by paying those taxes is what really savvy investors love. And that's really what CPAs love. That's what your financial advisors love. It's that ability to invest in what we call these hard, tangible assets that create these incredible tax opportunities.
So going back to the beginning again, when your financial advisor is telling you should get into something by the end of the year, it's because all financial advisors believe that deferring taxes is the best move for building wealth long term, and it compounds year over year as you do it.
I would usually stay away from always and nevers when it comes to financial advice, but generally it is accepted that, a deferring tax, keeping money in your pocket versus spending it a year down the road or 5 years down the road or 10 years down the road, there's no denying that there's a value for keeping that in your pocket today. And that's what rental properties allow you to do.
Okay, that makes sense. Let's go into, we got a couple of questions before we go into some more advanced tax saving strategies that Lee Bishop brought up here in the chat. Miguel Angel Sanudo asks, what about creating an LLC for our rental properties? Is rental activity considered as a business or as an investment? I guess I'm asking two at the same time because I thought that they come together. But can you talk about it as if you have an LLC for your properties and versus not having an LLC, and then how you are treated as a business or an individual?
Yeah, we'll just keep it simple with LLCs rather than going into different types of structures that have different tax implications. LLCs, everything flows through to your personal tax, to your personal, oh my gosh, personal tax returns. Thank you. Forgot the word there. To your personal tax return. So it's the same thing, right? JWB is an LLC with our different structures. We're LLC, so it flows through to my personal tax return. So the same thing that we're talking about as far as depreciation affects your tax structure, no matter if you have an LLC or if it's owned personally.
Okay, great. Yeah, and I remember you giving me some advice on that on my own business, right? Because I was wondering about whether I have an LLC. My business is an LLC, and I had some money in from before the end of the year, and I was wondering whether to invest it one way or the other, take it out first. But really, when you have an LLC, it is all going to still flow back to you. So the same tax strategies apply.
Mm-hmm.
Okay, great, cool. Sean asks, conversely, it hurts DTI ratios. I guess he's talking about depreciation. How do you overcome these ratios with lenders? First, like to ask you, Greg, what is a DTI ratio? And then if you have an answer for that.
Yeah, so debt to income ratios. So when you're looking to go get a loan, the underwriter is going to look at your adjusted gross income on your tax returns, and they're going to basically take that and they're going to measure how much of your revolving debt, your recurring debt happens, and they want it to be under a certain ratio. Usually 45% is pretty normal for getting a loan there. But the one thing I'll point out here, Sean, and Sean's active in real estate. So there's a difference between active income and passive income. I would imagine that Sean can take advantage of a lot of these deductions on the active side. Most investors cannot. You have to hit certain thresholds to be able to take these deductions against your active income. we would all love to be able to take these deductions against our active income. Then you could just buy tons and tons of rental properties and not pay anything on your active income. That's not possible for the vast majority of investors out there, because you have to be a real estate professional. You have to spend a certain amount of time. You have to do a number of hoops. So Sean, the only thing I'd point out there is everything that I'm talking about is in terms of saving you money on your passive investments, right? So, and you can't, and we'll keep it simple for everybody. If you're not a real estate professional and you can't, take it against your active income, we're only talking about the passive side. And the passive side is not going to affect you as far as your ability to get a loan, right? What your lender is going to look at is your adjusted gross income, which largely is going to come from your active side. So even if you have more write-offs than you can take, which largely is the case for when you factor in depreciation on a rental property in Jacksonville, you're not able to take that extra write-off and lower your active side. So long story short, shouldn't affect you in your ability to get a loan. It's just gonna zero out the passive income for you. So in essence, you're not gonna get a bump from the income you would earn on the passive side on your active side, and your active side is what's gonna largely determine your ability to get a loan.
Okay, that makes sense. So, right now I'm in the middle of closing on my JWB house, and I have all the lender documentation and framework is fresh in my brain because I've been sending him a bunch of stuff. Sounds like depreciation can only help you then if you have this qualifying income, right? Like your W-2 income plus whatever business income you have. You can't have so many deductions that hurts that. You can only have so many deductions that it nullifies the cash flow from your passive side, which nullifies it on paper. But again, last week we talked about how it doesn't matter what you're worth on paper, right? Like at the end of the day, it's still positive cash flow that's coming into you that's going to show in your bank account.
Well, yeah, I mean, nullifying it is another word of saying not paying taxes on it on your passive side. So yeah, and as far as your overall net worth, that is the least most important thing in my opinion, right? Anybody can come up with some fantastic evaluation of what their net worth is, depending on, right? What is that piece of art worth in your house? I don't know, right? But I mean, none of that really plays here, right? We're just simply talking about I earned $14,000 of gross rental income. I was able to take a certain amount of write-offs and get it down to about $3,500 of net rental income. And then I had this $6,000 write-off from depreciation, which is a non-cash event. And so you're not able to pay negative tax. You're not able to decrease your tax bill, right? Past zero. You're just able to write it off so that it's a zero tax event in that year if everything plays out the way I said here. Obviously I'm using numbers for a Jacksonville property. I should probably point out that if you're investing in a different part of the country, it's not going to be as advantageous as you see here in Jacksonville. Jacksonville's tax savings are better because our purchase prices and our rent amounts and our depreciation all work out so many times where you can wind up without paying any taxes on the rental income that you earn. It's not the same in every single part of the country.
Okay, that's another good little nugget. So then back to the original question then. Does depreciating your property hurt your debt to income ratio, or was that a misthought out?
It shouldn't affect your ability to get a loan.
Okay.
Right? What it would do is if you took no depreciation on your passive income rental properties, you would not have that, let's call it a $6,000 expense. Then you would pay taxes on, let's say, $3,500 of net rental income. So you would pay the taxes on that. And then that $3,500 would show up as a positive on your adjusted gross income, which would include your active side. So in theory, this would technically lower the amount of the adjusted gross income slightly, but most people would agree that they'd rather not pay taxes on it and take a slightly lower adjusted gross income. It's not going to take the full amount of the depreciation and adjust that negatively for your overall adjusted gross income. Does that make sense?
Yeah, made sense to me. I think it makes sense to my friend. So I think we're good to move on. All right, let's talk about this vehicle that I've heard about so much, the 1031 exchange, Greg. And we want to bring this up in the scope of, not only is there a yearly reason why you get these tax benefits, but there's also long-term plays in tax benefits of rental income properties. And 1031 seems to be kind of the crowning jewel of it that people love to talk about. Can you explain the 1031 exchange?
It's amazing. I love the 1031. I've done them regularly on our rental properties. It really is kind of tax savings and planning through rental properties. It's all of that on steroids. It's about the best thing that we've had to effectively plan and to pay as little in taxes as possible legally, right? That's what we want to do. We know that we do need to pay taxes, eventually, but if you can plan through a 1031 exchange, it might be many, many years until you pay that tax bill, or it may be never, depending on how well planned you are and how well your future generations follow your plan. But for those who aren't aware, a 1031 exchange is a part of the IRS code that allows you to basically make a sale for a property, have a capital gain for that property, meaning make a profit on that property, and then not pay the taxes at the time that you sell it, right? So if we go back to our earlier conversation, I was saying, well, you do have to pay you do have to pay taxes on the depreciation that you took when you sell it. Well, now we're taking it one step farther, and we're saying if you planned ahead with a 1031 exchange, you could sell a property and not pay the tax on the gains at that time. You could then sell that property, reinvest into a new property or properties in a totally different market, and then you could hold on to those properties and you could continue to get the tax savings, the depreciation that we're talking about in those properties. And then when it came time to sell that property or those properties, you could 1031 those properties again. And the core here is that when we can establish a way for us to grow our assets without having to pay the tax bill at the time of the sale, that's huge. Right? That's what we're able to do in IRAs and 401ks. You're able to grow your assets without having to pay the tax bill until the end of, until you're 59 and a half. Well, this is a strategy, the 1031, that takes sort of the normal standard deductions, right? Everything that we just talked about plus depreciation, and go one up and say, even when you sell, you no longer have to pay that tax bill at that time. You can grow that into a larger number of assets than you could have if you had to pay that 30% or maybe 40% tax bill.
Awesome. So when we spoke about this the first time and I was trying to figure out ways to frame this thing. The obvious answer is, if you have one super expensive property in California that's worth $500,000 for a 2-bedroom apartment, you can now tax defer, 1031 exchange into 2 properties in Jacksonville or whatever, right? Like that's an obvious one. The other one that came to mind was the idea that even if you were investing, let's say, I'm buying this property right now in Jacksonville, Florida with JWB, and I want to, at some point, let's say, decide I want to diversify my investments into commercial real estate or into another, some other kind of real estate asset class that I want to do. I now have the ability, because I'm thinking long term, in investing in a rental property that pays for itself cash flow wise, I now have the ability to leverage that thing for whatever other bigger deal I may come up with later in the future, right? It is kind of like a resilience play that allows you to diversify if you ever get a wild hair in your brain.
Yeah, I mean, there's many investors out there who look at rental properties as a stepping stone to other real estate investments. And so probably what you're talking about is the fact that you can do a 1031 exchange from rental properties into a commercial property, right? Or into a multifamily property or into an apartment complex. It has to be a like kind investment, which any of the ones that I just talked about is fine. You can't go out and do something off the wall that is not anywhere like kind to rental property investing. But for those who want to be in rental properties first, and it's kind of like the easiest way for many investors to get into real estate investments is through single family rental properties, because the financing is so easy compared to other forms, and they want to get their feet wet. And it's generally understood. A 1031 can be an opportunity for you to, in a tax advantaged way, use that as a stepping stone.
I love that, man, because I just think it's, I'm not a super savvy investor, right? But I've played in the stock market and I've done okay, but it doesn't lead to other opportunities. It just leads to me being like, man, I hope this Peloton stock doesn't go down, and do I sell it now or not, right? But the idea that the gateway to this other world of investing that isn't stock market, right? That is this real estate, can be made so easy by just getting in on one JWB property to start, using that cash flow to buy more, leveraging the 1031 exchange at some point if I want to diversify into something else, right? Like I am very enamored by the idea of the gateway drug to investing like a big boy, right?
I like that. Rental properties, your gateway drug to real estate. I think that has some legs on that one.
I think depends who you target on Instagram on that one, but yeah, like I just wanted to highlight that because it's unlike any other asset that I've ever been kind of made privy to, right? Like the idea that this is something that starts one. I love whiskey, and I love the idea that I can have a whiskey neat. It tastes and smells differently. Then I put an ice cube in it, tastes and smells differently, and as it melts, it changes the profile, right? Like I get the sense that getting into rental income properties has that journey of it continues to open up more doors for you.
Well, it does. And, just from a pure tax savings perspective, there's no other asset class that I'm aware of that has these same types of opportunities. I mean, it would be like you buying into shares of a mutual fund, being able to sell those shares for a profit, not pay the taxes on those shares, and then being able to invest in some new stock fund or whatever. And that's just not possible in the stock market, right? You either pay the taxes on the profits that you earn in the first year at your federal income tax bracket level in the stock market, or you pay capital gains, long-term capital gains, which is generally a reduced rate. There's no, hey, I'm going to sell my stock and not pay the taxes on it at this time, reinvest in something else in the stock market. But in rental properties, you get that, which is incredible, right?
Yeah, makes a lot of sense. All right, man, we got a couple more questions here. Marilyn Cotterman asks, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
That's right. Marilyn Cotterman asks, what about when you die and someone inherits your property through an irrevocable trust? Do they pay estate taxes, or is there some depreciation benefit that they can take over?
Oh, Marilyn, you got me on this one. I don't know the answer to that one. I know enough because I've lived it. But there's a lot of questions that I'm sure you guys are going to have that I'm going to direct you to your CPA. And that would be one of them.
There you go. You've lived through a lot of it. You haven't lived through passing away and having to give away.
There you go. That's a good one,
right? All right. Miguel Angel Sanudo asks, can we deduct any bills for repair/renewing work made in one of our properties prior to purchase? Having that this cost was included in the final price we paid.
That's a good question. No, you're not able to take a deduction for repairs or renovation costs done prior to you owning the property. It would just be after you own the property.
All right, there you go. Greg, I think I think we did a pretty good job here of illustrating, what we came to illustrate, right? Like number one, the idea that you need to do it by the end of the year is a matter of how much you value putting around $1,300 in your pocket in the next 4 months versus the next 16 months, right? Which there is a benefit, but it isn't something that you need to go crazy over. But there is an incentive there. Uh, the different tax benefits that this asset class, rental income properties, provides are vast, right? From the standard deductions to depreciation, which turbocharges things, to these long term strategies with a 1031 exchange that can also lead to other things that you hadn't really planned out, like a fine whiskey. And I guess we got one more question here. Margaret Smith asks, wait. How does all this change when we source our funds when the source of my funds is my Roth IRA?
Yeah, we should talk about that. And what we're talking about is if you're buying properties in your personal name, right, or your LLC, right, anything that is not in your retirement accounts is what we've been describing on the show. And everybody should understand on this show that I'm trying to show you, and Pablo and I are trying to show you the big picture here, and that there are a lot of finer details. Like there are specific rules for doing a 1031 exchange that you need to be well versed on before you go and you do a 1031 exchange. If you have questions about it, you can reach out to my team. We have a 1031 custodian that we work very well with, and we could get those questions answered for you. It's a part of the plan to do it. So take this for the high level overview. Don't take it and run with it without talking to my team or to other professionals. But specifically, I'm describing this as if you're buying it in your personal name or if it's in an LLC, which rolls through your personal tax return. In a retirement account, either a Roth IRA or a traditional IRA or any 401k, solo 401k, right? Your tax savings are already built into the structure you're buying because it's in a retirement account. So for a traditional IRA, it's tax deferred, putting the money in there, meaning that it's pre-tax. You put the money in there, you don't pay taxes on it up front, and then it grows tax deferred all the way until the end when you eventually take the money out. And then you pay taxes at the very end. You don't get additional benefits from depreciation, like I've just been talking about, because the benefits that you get are better than depreciation in essence, because it's always there for you once it's in that tax deferred vehicle. Same thing for a Roth account, or a Roth IRA or a Roth 401k. Those benefits, you paid taxes up front before you put the money in there. And then if you buy rental properties in that Roth IRA, your gains grow without you paying taxes on those ever, right? So you don't get additional benefits from depreciation. You've already got the supercharged benefits that you would be getting simply being in those accounts. So you don't get additional benefits, but you're fine. You got huge benefits from being in the Roth 401k or a traditional 401k or IRA.
Got it. And again, name of the game of the benefit is tax deferment, money in your pocket now and pay later, right? Mm-hmm. Which is, we all can agree on. I got a couple questions that just roll in. Aaron O'Neill asks, do you have to have a certain number of properties to have a 1031 exchange?
No, you do not have to have a certain number of properties to do a 1031 exchange. There are just rules when you sell your property. There are rules that you have to follow in order to qualify the next purchase for a 1031 exchange. I'll go over a few of them just to share it with everybody. There are timing rules. So you have to identify the next property or properties within 45 days. You have to close on the next properties within 180 days, and those are concurrently. So you have to close within 6 months. You have to put the money with a third party, so you can't touch it when you sell the property. Those capital gains you can't touch. And the properties that you purchase later on, you sold over here, you're taking the capital gains, you're rolling it into other properties. They have to be for a higher purchase price than what you sold your properties for. So that's how the government is encouraging additional investment. You have to keep stepping up your costs.
Awesome. That makes sense. So within that, can you take a 1031 exchange and buy 5 properties that make up more of a value than the original 1 property?
Absolutely. That's really common, especially a lot of clients out in California and New York where property values have gone up, especially over the last, 8 years. They have significant equity. They'll sell that one property for $1 million, right? And take whatever that capital gain was and buy 5 properties in Jacksonville. And the total value of those 5 properties would be more than the $1 million. And that's how they hit that threshold.
Cool. Zach Correa says we do it in Seattle. And then we got one last question here from Kurt Stein, another one of our spike ball brethren.
What's up, Kurt?
Kurt asks, how do you do a 1031 exchange? Is it an IRS form that you fill out? Does your CPA do everything for you? I'm going to add one more piece. Does your JWB portfolio manager do everything for you?
We do as much as we can. Really, there's a 1031 custodian that you're going to want to work with. I think technically you can do this by yourself, but I wouldn't recommend it because you do have to have the money so regimented in different accounts and it can't be commingled and all this good stuff. I mean, really, if you don't do this right and the money, like I've seen horror stories where people think that they have their 1031 set up correctly, the money gets distributed to their personal bank account from closing by mistake and they're toast. They can't do the 1031. Once it comes to your personal bank account, you cannot do the 1031. So there's a 1031 custodian that you would want to work with. Kurt, you can reach out to my team. We'll get you connected with the 1031 custodian that we have worked with for many, many years, and they'll put you in the right spot.
All right, Margaret Smith coming in. One more. So if I had a choice and want to leverage my funds with a bank loan, should I use personal money or Roth money?
Well, Margaret, there's not a one size fits all answer for that one. I would really encourage you to reach out to my team and have that conversation. That's really what we love to do, is to start that planning process. And part of the planning process is, we ask you to share what are your, call it, non-qualified funds and what are your qualified funds. Non-qualified funds would be your personal funds, anything that's not in a retirement account. Qualified funds would be in a retirement account, and we can help put that best plan together for you. It's just too hard to give you an answer. There's a lot of pros to both of them.
Great. So I put chatwithjwb.com there in the comments. That's how you schedule a call with the team. Again, if you want the investor kit, if you want the web class, go to jwbwebclass.com and get a little bit educated if this is your first time coming, or if you just haven't taken a class, or you just miss Gregg and you want to see his face, which I totally understand. Gregg, speaking of that, man, I missed you, buddy. I've been gone for a week. I'm sorry I missed our run this morning. I will make it up to you on Thursday with a blistering pace. But I thought this was great.
That's a good thing. I don't know if that's a good thing or a bad thing, man. I've missed you. I haven't had nearly enough Pablo in my life for the last 2 weeks. Don't do that again, man. Don't do that again.
I'll see what I can do. But more than anything, I want to thank everybody that's been with us. We had over 40 people with us most of this call. Still blows my mind to this day that 40 plus people take an hour of their day to hang out with us, middle of a Tuesday. I encourage you to join us on Thursday, where we do the JWB Rental Income Property of the Week.
Week.
And there we go into real nuts and bolts of how properties perform. We break down the deals that are available right now that somebody may or may not have just picked up, but it's a very real example of how the market is and what you can expect. And we go through the breakdown, what you get as part of the investor package. So I hope everybody joins us on Thursdays. Next week, we're going to be talking about what, Gregg? We're going to be giving the JWB quarterly market update, right?
That's right. Yeah, man. It's amazing how time flies. We've got all the stats ready, and we'll share with you guys what really is happening here in the Jacksonville real estate market. We'll talk a lot of MOI. We'll talk a lot of pricing. We'll talk a lot of rent collection. So I'm looking forward to it.
Awesome, man. And I'm just geeking out with the comments. We got John Henning saying, great show, guys. Bill Shields saying, we love you guys. Thanks for the usual brain overload with great info. Lee Bishop, you guys rocked it again so much. Sean Pointer, thank you guys. Agreement. It's just awesome, man. Like the amount of love in this chat and the feeling that we're all friends here is just really, really overwhelming and cool, man. So Gregg, I'll leave it up to you to say goodbye to everybody.
Thank you, everybody. I echo Pablo's comments. I love the group that we have, right? It is, call it 40, 50 folks that show up every single week, and we really, really have a good time. And it feels like a community, which I didn't know was possible. So thank you guys. And listen, we just talked for an hour on taxes, and it's hard to do that, right? Thank you guys. Good job for educating yourself, and for allowing me to share some thoughts with you guys, because I think it's really going to help. And most people hear taxes, they turn their brains off, and they definitely don't show up. So I appreciate all of you for showing up. That's half the battle, and I hope it was value to you. And then if you would like to do it again, we're going to do it tonight in the watch party. I know many of our friends here on the show do a redo. They listen to it again. And so I hope all of you can make it in the group on the watch party. To go to the group, go to jwbfacebookgroup.com. I will be there at 9 p.m. I'll notify you if you're in the group, and I'll see you there for a live Q&A.
All right, buddy. See you there.
Take care, everybody.